Hey everybody, Chris here with Mike Solorio of Prime Lending. Mike, I have I'm so excited to have you share this information with us today, talking about the CalHFA Dream for All loan program that I've been getting questions from my buyers about. What can you tell us about it?
Sure. So it's a loan program for first-time home buyers, meaning you have not owned a home in the last 3 years or been on title. That's what defines first-time home buyer.
Okay.
What the program offers is a loan of 20% that would have been your down payment that would have been required. So you do two loans, a first loan, 80% of the purchase price, and then this program offers you a second loan at 0% interest for the remaining balance of 20%.
So it's like 100% financing. Is that what I'm understanding?
Exactly. You got that right.
100% financing. You don't have to have any of your own money for down payment. You get an 80% loan that you make payments on, right? Based
Correct.
on the whatever the current interest rate is. And then the 20% that kind of acts as your down payment, as it were, is a second loan that you don't have to make any payments on. Is that what I'm understanding?
Absolutely correct. There's no payments on that.
That sounds amazing. It sounds too good to be true.
Yeah.
Tell me, Mike, what are the restrictions, requirements? Like, how does someone qualify for this?
Yeah, absolutely. So there is an income limitation and it's based on county. And so for San Diego County, you cannot earn more than $211,000 and
Per individual or per household?
per household. Those who are going to
Okay.
be on, yeah, absolutely.
Okay.
And there's a credit score minimum 680 credit score. And like any other loan, you're going to still need to qualify. So there will need to be minimum income based on your debt to income ratios.
Got you. And that'll vary from person to person, property to property, right?
Yes, absolutely.
Okay, great. What are some of the benefits, Mike, of using this first-time homebuyer program offered by the CalHFA Dream for All versus, say, for example, I don't have 20% down, which sounds kind of cool, but then I have to pay it back, versus so should I just go and do like a 3.5% or a 5% down? Is there a benefit to going through the first time home buyer program as opposed
Yeah,
to
absolutely, Chris. You mentioned a few things there, and I want to answer that part. You mentioned payback. So the only catch with this second is that
right?
there is a shared equity component. So when you do go to sell, there's going to be shared equity, and it's going to be based upon the percentage that you borrowed. So if you borrow the full 20% of this program, you'll need to share in the equity appreciation and give 20% back to the program. I'll go through a scenario here and we'll go through
Yeah,
the.
thanks. I was just going to ask you about that. Can we go through an example of
Yep.
what this is? Because you said, when you eventually sell it, you
Yep.
have to do a payback and then also an equity share. So let's
Yep.
have an example.
Yep, absolutely. So let's take a 700,000 purchase price.
Okay.
If you were going to do the CalHFA program, let's start with that first. 80% loan on the first, 80% of 700 is 560,000. That's your first loan.
Okay.
The second loan, which is the remaining 20% to get you to 100% financing, would be 140,000 in this example. So
Okay.
that would make up the entire 700,000 purchase price, is that you're borrowing on two loans. Now, that 20% second loan that CalHFA Dream for All is offering, there are no payments and it is 0% interest. So your monthly payment is basically based on the loan of 560,000, and there's no mortgage insurance because you have that 20% component that through the second loan. So you're making payments based on 560,000.
Do you qualify based on the 560 or do you have to qualify on the 700?
Exactly. You qualify on the 560. So
Oh, that's fantastic.
yeah, exactly. So you're qualifying on a lot smaller amount and a lot smaller monthly payment than if you were to do some other example, which you mentioned, maybe putting down 3.5% down.
Right.
If you do that scenario, if you run it through the numbers and you do a 700,000 purchase price, putting 3.5% down, you can see real quickly that your loan amount is much higher
Right.
and your monthly payments are based on what you're borrowing. So that monthly payment is a lot higher. And there's
Right.
definitely going to be mortgage insurance because you have less than 20% down.
So that's adding on more per month.
Yes. So that
Wow.
monthly payment on that classic scenario of 3.5% down is significantly higher, and less people will qualify for that,
Makes
obviously,
sense.
with a higher payment.
Wow. Okay. Cool. So let's go back to the equity. Like at some point down the road, when you decide that you're going to sell the property.
Right.
How does that work? So let's say 5, 10 years down the road, whatever the time period is, depending on how market appreciates, you sell it for $1 million. You bought it for 700, you sell it for 1 million. How does that work with paying back? What do you need to pay back, and what do you need to share?
Yeah, absolutely. Great question. So let's say that on the 700,000 purchase price scenario, you end up selling it for $1 million. Now, let's say that's 5 to 10 years down the road. Just like any sale, you're going to need to pay back the outstanding balances on the loan.
Right.
And at that time, your loan, remember you had one loan at 560,000, you've made payments on that. So that's come down quite a bit. Let's say you still owe 500,000 on that loan. And
Sure.
that second loan that was offered through this program, it hasn't changed, 0% interest, and you've made no payments. You still owe 140. So remember, we add 500 plus 140
Right.
means you have outstanding loan balances of 640,000.
Okay.
To pay that back, that leaves a remaining balance of, do the math real quick here, that's $360,000 profit, one would say, right? And that's what typically you would get as a seller when you sell that 360,000. However, know that there's a shared equity component to that loan. This program wants to take, or the program requires taking 20% of the appreciation. The home appreciated 300,000, 20% of that is 60,000. So the program is going to want to take 60,000 of that 300,000 appreciation. So you'll get 240 of that appreciation. So this program is good for two different types of scenarios. One is where you don't have the down payment, regardless of the purchase price. If you don't have any down payment currently, you're
Right.
going to get a loan that has a lot of components that make it more expensive to get that loan. So if you're limited on funds, this program helps you a lot. Also, if your purchase price is just slightly out of reach, or you want to move up a little, reach for a higher purchase price, this program will also offer that benefit.
Fantastic. Everybody, if you want more information on this CalHFA Dream for All home loan, please give me a call at 619-925-2322. I will make sure that I hook you up with Mike, and he will answer all your questions. And hopefully, if you're sitting on the fence, this might be a great tool to help you get into a great home at a fantastic point in time. Thank you so much, Mike. Appreciate your time.
Bye. Take care.